dividends calculator. We had some comments down below speaking to the fact that the market doesn't always go up. And you know what? That is fair. And so I have made some updates to the live off dividends calculator that account for market turbulence, that look at when the market is in a bull run and look at when a market is in a bear run and give you the simulation for both scenarios, guys. Of course, it's not financial advice. I'm not a financial advisor. And if you're going to use the calculator, use it at your own discretion and come to your own conclusions with it. But it's meant to be a fun example, an entertainment and education for looking at the market and looking at this simulation of living off dividends over an extended period of time. All right, guys. So let's check out the calculator and look at some of the updates I've made. All right, guys. So as per usual, this calculator will be available via the Patreon. If you'd like to access the Patreon, I will leave a link in the description below to access this calculator in our Patreon community. All right, so going into the calculator, the live off dividends 3.0. I'm going to just cruise through this because we just did a video on this. But first step is add in your expenses. Next step is adding your amount to invest and selecting your investments. All right, so I've selected to invest 500K. My expenses are 5,400 a month. I'm going to reinvest a percentage of my dividends back into the investment. And here are the investments I've chosen. All right. So QQQI, SPY, BTCI, T-SPY, GPIC. Maybe down the line, I'll choose TDAC, which I know a lot of folks are excited about. Their yield on the first dividend payout has been phenomenal. I think 17% trailing 12 month. Really strong stuff. So maybe I'll add that in another on another day. But as we've looked here, as we've seen here, all the assets here are 100% return of capital. In year one, our monthly income does exceed our monthly expenses by 216. So all is good there. All right, guys. So here is where I've added in the updates. All right. So on tab 3, this is where we're going to future proof our plan and account and look at return of capital and see how that affects the portfolio. Essentially how many years of return of capital benefits do we get before we have to start paying taxes, something that this sheet does and shows you a 20-year lens of the portfolio. But now, instead of just looking at one setup of effectively a bull market return, we now can estimate the bear market return and then check out and add in a down year chance. And if we look at the S&P 500, on average, it's down about 20 to 25% of the time, right? So 75% of the time, maybe even more, it's generally up during the year. And then about 25% of the time, it is down. So we're using that 25, 24% down chance in this simulation. But you can see here that we have it set up where during a bull market, this portfolio will appreciate by 3%, and the bull market yield will be 17%. And then during the bear market, we go down by 11% because these funds, they're not going to appreciate much, but certainly in a bear market, they can come down. So in a bear market, we'd see an 11% depreciation, and we'd bring our yield down because we have less NAV, we have less funds to work with. Likely our yields will come down. Sometimes they might come up, but generally speaking, what I've seen is the yields do come down during some of these bigger bear runs. And you can look at XYLD, you can look at JEPQ, you look at JEPI, you can look at some of those ones that have longer history to see that the yields do come down during bear markets. And also certainly they depreciate in terms of price action during bear markets. So we've set those up. And in this calculator, you can adjust accordingly. If you want to do negative 15% on the bear, if you want to do negative 10%, if you want to change your appreciation, you can do so in this cool calculator. All right, so you can see, guys, here, and I'm going to maybe just zoom this out just a bit, but you can see here, guys, that this will randomize the years that you do go down and the years you do go up, but it does it is affected by the down year chance of 24%. All right. So, year 1 to 4, we have up years. And then year 5, we have a negative 10% down year. And then again, a big year along a big appreciation stretch, and then a down year. And then a big year or a green year, then a down year, and then the rest green. Right. So this will randomize. And again, because I cannot predict the future. And so this will be a random chance. Of course, 25% of the time it'll be down. But you can see here, guys, that with this structure, we get a better understanding of what's going to happen throughout throughout our journey here, right? So in the beginning, our starting value 500K. Of course, the dividends that we get are going to be return of capital, so we're not paying tax. And in this case, we're not paying tax up until the 6th year. And I've set a portion up for drip, right? So 10% on drip. And you can see here, guys, that we're going to continue to appreciate the portfolio. We're growing. We have cash flow. So again, on the other tab, we looked at our expenses. So we have our dividends that we're withdrawing minus our expenses, and that gives us a little bit of cash flow. So you have a lot of cash flow. But you can see here, guys, that once we hit that bear market, once we hit the bear market in effectively year 7, and it might happen earlier, right? This is where our market yields go down, and this is where our we depreciate, right? The price is coming down, the value of the assets are coming down by 10% in this case. You can see that in this year, with this 500K portfolio, we do not have enough cash flow to manage the expenses, right? So now we can see here that um, we've generated 65K in dividends, of which we would withdraw. So about 60K in dividends we withdraw, but our expenses are 72K. So in this case, you can kind of model and look at it. You can say, okay, if I want to live on dividends in this time, maybe I want to reduce my expenses. I cannot spend 72K in this case. I got to reduce it down to the expected withdrawn dividends for this bear market period. Or maybe you need to work. Maybe you have to find different sources of income, right? And in this example, you do see that we have a couple years of negative cash flow where the dividends, while we do receive dividends, in this case like 60K to 50K a year, it doesn't match the expected expenses that you'd have. And of course, I am accounting for inflation here, so every year your expenses do increase. So this is what's called market turbulence, guys, where sometimes your yields and the market goes down, and in those times we have to adjust accordingly. So again, maybe it's picking up a job, maybe it's sourcing other income, maybe it's this portfolio isn't ready for extracting this much income from it, and you have to drip less. There's a lot of variables to consider, and that's for you to decide what to do. But this gives you a lens of market turbulence, of a situation that happens when markets aren't going to be so rosy. Right now, we're in a major bull run, and that's great. We're seeing great results. But what happens when we inevitably get into those bear patches? It will happen. And when it happens, your value of your assets will come down, and potentially those yields, your distributions will come down. And so, yeah, effectively, you have to account for that and acknowledge that and plan accordingly, right? And maybe it's a matter of, we need a higher investment base. Maybe 500K isn't enough for the amount of expenses that we have now. Maybe, again, it's picking up an extra job. Maybe it's having different sources of income. You never know what you want to do, and it's up to you. But this example now, guys, gives us that better lens of bear market bull run. And with it, in the end of this, in the end of this, and again, it does variate, but in the end of this, we'll have a net end value of 621K in the ending value. All right, from 500K, we would have had appreciated to 621. And again, these assets are not meant for major appreciation; they're meant for generating income. So the end balance would be 621K, and your total income throughout the period would have been 1.7 million, because you're still earning great income. But of course, like, the appreciation may not be there in a big way. Total return in this case of 371% over a 20-year period, guys. So you can make and adjust this as you see fit. In this case, if you want to increase your down year chance to 40%, you can do so. If you want to bring down your bear market returns to negative 15%, you can do so. If you want to bring down the yields, you can do so, right? Like, you can decide how this works. And again, the market returns will dynamically, randomly choose which year based on this 25% year chance, right? So This is a fun exercise and maybe a more accurate exercise to look at what happens in a natural flow of things, right? We're not always going to go up. We will have down periods, and we want to account for that when it comes to dividend investing. All right, guys, let me know if this is helpful. Let me know if this is a more accurate lens and into dividend investing and into how market cycles work. Please let me know in comments below. Please sub to the channel, guys. All the best and cheers.